You've spent months in negotiations and finally signed the letter of intent. You're finally picturing life after selling your B2B service firm. Then, days before closing, the accounting team sends a spreadsheet. They calmly explain your final payout is dropping by hundreds of thousands of dollars. This shock usually stems from a specific misunderstanding of the phrase cash-free, debt-free. Most founders assume this means they empty the bank accounts, pay off the loans, and walk away while the business continues as usual. This table breaks down the disconnect. On the left, sellers expect to keep their cash and accounts receivable. But look at the right side. Buyers expect to acquire a company that can run on day one. They require enough operating liquidity to cover payroll, rent, and vendor bills, while existing invoices convert to cash. To an institutional buyer, your accounts receivable and your unbilled work in progress are the necessary fuel for operations. They expect that cash pipeline to remain in the business to keep the lights on and the staff paid during the transition. When sellers assume they own the pipeline and buyers assume they are buying a fully stocked balance sheet, the deal hits a wall. This fundamental misalignment creates the 11th hour escrow ambush, where the buyer demands you leave extra cash in the business just to reach the finish line. This formula is the exact mechanism buyers use to enforce their view. Current operating assets minus current operating liabilities. This calculates your net working capital. In a deal, the net working capital peg is the agreed-upon baseline amount of operating liquidity you are legally required to deliver at the time of sale. Think of it as a strict fuel gauge. If the business reaches the closing date with less working capital than the peg requires, the buyer will not cover that shortfall out of their own pocket. The math is direct. If your target peg is $1.2 million, but you only deliver $900,000 at closing, that $300,000 shortfall is deducted from your purchase price. It is a dollar-for-dollar reduction. If you manufacture goods, buyers focus on physical inventory. But in a service business, your product has already been delivered. The entire value of your working capital sits strictly in your invoicing and your ability to collect. You value your business based on cash flow, but you close the sale based on balance sheet definitions. The working capital peg functions as a hidden, secondary valuation that can quietly erase millions from your final payout. This timeline maps how negotiating power decays. At the letter of intent phase, you have power to define accounting rules. Skip these details to secure the headline price, and you effectively permit the buyer's team to write the rules during escrow. By the time you reach the finish line, positions have hardened. You have zero leverage. Arguing over accounting definitions when the buyer is the one holding the math is a losing strategy. Committing to the friction and legal tedium of drafting specific rules during the LOI phase protects your headline price against late-stage accounting games. To set the peg, both sides have to agree on what normal working capital looks like for your firm. That baseline is calculated using an averaging window over a specific period of time. A savvy buyer might cherry-pick a single massive peak billing month to establish a normal baseline. If you accept that peak, you leave excess cash behind. Your defense is a normalized trailing 12-month average, establishing a realistic threshold for the full year. A single peak month misrepresents your actual operating needs. Allowing a buyer to dictate the averaging window means you are literally paying out of pocket for your own company's seasonality. Beyond the averaging window, the actual line items on your balance sheet contain traps. Service founders often assume certain assets belong to them, while ignoring blind spots that buyers reclassify as liabilities. Unbilled work in progress is a prime example. If your WIP is based on vague estimates rather than documented earned milestones, buyers will treat it as unreliable. They may strip it from your asset column and classify it as a debt-like item. Accrued labor costs create another risk. In California, accrued paid time off is legally treated as earned wages that require a cash payout at separation. Buyers frequently categorize this as a hard liability right alongside deferred revenue. If you don't dictate how these items are treated early in the deal, the buyer's team will sweep them into the calculation. Assets vanish, liabilities spike, and the peg swings violently in the buyer's favor. Sloppy bookkeeping functions as a structural liability. Undocumented client work and vague accrued expenses give the buyer's financial team the leverage to redefine your balance sheet in their favor. Cash collected before closing generally stays with the seller. You must convert outstanding invoices into actual bank deposits before the transition officially ends. Treat this period like a ruthless collections campaign. Send out invoices the moment work is completed and aggressively close any billing gaps in your current projects. You must also resolve client disputes within 48 hours. If you allow invoices to age, the buyer will flag them as toxic receivables, excluding them from your working capital and pulling that money straight out of your payout. This creates a difficult trade-off. Enforcing strict payment terms and tightening change orders right before you hand over ownership can agitate the core clients the buyer is paying to acquire. You have to balance those relationships, but surviving the working capital peg requires treating your final 90 days as a highly disciplined cash conversion cycle. Your vulnerability to these adjustments depends on your daily operational style. How you run your firm right now determines where a buyer will attack your balance sheet. Consider the lean operator. If you routinely take heavy quarterly distributions and run your operating accounts close to zero, you are highly exposed. Buyers will look at your accounts and demand a massive cash infusion at closing to ensure the business is viable. Then there's the seasonal operator. If your service firm has massive revenue swings, you are completely vulnerable to a buyer cherry-picking your best month to set an artificially bloated peg. Neither style is inherently wrong, but both become financial liabilities if your historical data isn't aggressively contextualized before diligence begins. This is your final defense plan. First, establish a trailing 12-month average as your baseline. Second, define what counts as billable work in progress. Third, quantify accrued labor liabilities up front, separating bonuses from paid time off. Fourth, explicitly forbid using isolated peak months to set targets. The working capital peg sets the fuel level for your successor, but you are the one paying for the gas. Defend your balance sheet with the same intensity you defend your EBITDA multiple, because an unprotected LOI guarantees a financial ambush.